quarter, which is kind of an interesting thing. You see MasterCard is the last one to get in 66. Understanding what your credit is, what is the score, the range, the FICO score, which is important to differentiate between other models. When you go, there's a million different places you can go and pull your credit score online today. The vast majority of them do not sell a FICO score, so they're their own proprietary models, which means, you know, I had a client that had a 750 credit score, he told me, and we got to doing some financing, and when we pulled our models, which is FICO, his score was actually 650. And what that means is there's a model out there that runs from 450 to 950. So this person is going through life thinking they have awesome credit. They may have got approved for their business loan. They may have got approved for their credit cards. They've never been denied for certain things. But the understanding is that maybe that business loan is at 8% versus 4%, which it could be if you had that true rating. So it's important to understand that when you're going online and looking at those things, that score probably really doesn't mean much. This is the components of what makes up your credit score. Payment history is 35%. What's most important to creditors is if you pay your bills on time. Debt level is another 30%. What does that mean? They're talking about credit utilization. That's your balance to available on a credit card. So the greater that gap is, if you have a credit card that has a $50,000 available and a zero balance, and you've also had that for a long period of time, that's affecting and helping your credit score in a large way. Length of credit history is 15%. The more length that you have to the credit, the more that the FICO has to see and how you've managed that credit over time. So if you have a brand new account, it's not weighing a lot to that score, positively or negatively, because there's not a lot of history for that to see. Inquiries are 10%, and mix of credit is another 10%. If you go out and say, you look for a lot of different credit cards for whatever reason it is, and your credit's pulled 10 different times, that starts to get to be a flag for the FICO model, because it's looking at as you're trying to acquire debt for a certain reason, and they get a little bit afraid of that. So it starts impacting your score negatively. Where that isn't as important of a point is if you're applying for a car or a mortgage, they understand that that's a large purchase, and they give you a longer period of time to shop before it negatively impacts your score. And then mix of credit's important. FICO says to have great credit, you have to have a blend of credit. So what does that mean? That means you have to have installment debt and revolving debt. If you only have one or the other, you can still have good credit, but it's not going to be great credit. Out of thousands of credit reports, the highest score I've ever seen was at 842, and that particular person had 20 different trade lines and was an older gentleman. So history, the amount of them and everything added to where you get to that score. It takes an awful long time to get to that 850 marker, if you can. I don't know that it even exists, but that's something that will take a long time to obtain. With that being said, once you kind of exceed the 740 marker, it's really just bragging rights. You know, there's not really any creditor that's going to give you negative marks if you're over that score. This is another thing I put up here because I get a lot that people feel that the credit bureaus are government-backed agencies. They are for-profit private businesses that are in the business of selling your information. That's their only task. And they maintain millions of files. Where do they get their information? Mainly it's from lenders reporting your credit history, account types, balances, and inquiries. Also, public records are a thing from court records, bankruptcies, judgments, etc. And they also obtain information from you, current residents, etc. This is the first time FICO ever released a range of how things can negatively impact your score. And there's two columns here. One is the 780 score and one is the 680 score. The reason why, when you have better credit, that it impacts you more as far as the score is because you've never had a negative event happen to you previously. When you're lower, it's looking at that history of negative and it blends, so the impact additionally isn't as much. But you can see here, you know, a maxed out credit card, which means when you're over 50% of the available balance, it's considered maxed out by the credit bureau. You want to get it under 30%, ideally under 10. After it's under 10, you're not getting much more as a positive star, if you will. But as you go down, you can see bankruptcy is the worst as far as impact to your credit, foreclosure, debt settlement, etc. It's important to note too, foreclosure, short sale, and indeed in lieu of, are all things that a lot of us maybe have had friends, family in this marketplace that have gone through those types of situations. To a lender, if they're going back to get a mortgage, it's considered the same thing. It does impact your score differently. Those other ones I mentioned do affect the score less than what you see here, but the time it's required to pass before they can get a mortgage, it's considered the same. Even if you get to a 90-day late, a mortgage lender will say you're in foreclosure based by the underwriting guidelines. This is a look at the FICO 8. This is the new model that they rolled out, and it just touches base on some things that they're looking at more than in the past. I don't know necessarily how relevant it is, but I thought I'd throw it in there to see if you can kind of take a look at what they're doing. The new model is more sensitive to how they utilize credit cards. So you see this with the credit card companies, but they really used to like the person that was close to their max all the time, but they're paying their bills on time. It was a great client for them because they're collecting more interest, etc. But they're now backing away from that scene because of the risk and what's happened here in the recent past, and hence why these changes are coming into play there. Isolated late payments. They're less likely to impact you as much as they did in the past. If you maybe they're looking at it as I lost my bill, I moved or whatever. That was just one payment late. It's not going to affect you as much as it did in the past. So, and if any of you guys are really interested in this stuff, you can ask us for a brochure that has all this data in here. We'd be happy to do it. This is a slide. The cost of poor credit. What does that mean? If you're below 680. You're really starting to get into what we're talking about here. And these are just some areas where it's going to affect you. Business credit, all of your loans, your insurances are risk-based pricing, your cell phone's risk-based pricing. Employers look at credit a lot. I know of an incident where I had a friend in HR where they had a person that had close to an 800 credit score they didn't like as much as the other person. They really liked the other person, but their credit was in the 650s. But they had a salary range. And the one that they offered, instead of it was $50,000 to $75,000, they offered the person that had a lower credit score the job because they liked them better, but they gave them the lower end of on the salary. So that's just an example of how things are working in the marketplace. As you can see, average cost of poor credit to an individual is $3,000 to $4,000 a year. You can see how that compiles to a business. I had a client that he was just above 800 on his score. He had a credit card that he had for, I think it was 18, 19 years, something to that effect. He had a $50,000 available, a zero balance. They just kept it for safekeeping, emergency use, that type of situation. And they got closed due to inactivity. His score went down to 666. I won't forget it because of that number, but he was re-upping, and the reason we got the call is he was up for his credit renewal on his line of credit for his business, which is a very substantial line. And even though that he had been with that bank for 10 years, his rate went up 2%. Here's just an example again of how, in numbers, how it can impact you over time. You can see in this example, it cost him $45,000 to carry a balance on a credit card for that time frame. On mortgages, I did this slide about 6 months ago. Mortgage rates are more 4% now, but again, the message is not understanding where your credit is can impact you, because utilizing your credit in the right ways and understanding how it works really helps you bump up those scores and help in all those categories. So in this example, it was an additional $170,000 that they paid on that mortgage. If negative events have happened to you, friends, family, this is an example of how long things stay on credit report. Delinquencies, most of them are 7 years. As you can see, there's a couple that are longer, bankruptcies and unpaid tax liens. And inquiries, this is an interesting thing. When you go to apply for credit at a bank, an auto, business bank, or your SBA loan, whatever it might be, that's a hard inquiry. When you get an offer in the mail from a credit card company or something to that effect, that's a soft inquiry. Soft inquiries are not supposed to affect your score, so you don't have to worry about them too much. I have seen instances where they do. There are ways to get them removed from your credit. But they stay there for 2 years, but they only affect you for 1. So if you have a hard inquiry that's 2 years old or over 1 year old, it's not affecting your score. Here's 10 credit myths. We get this a lot. There's only one score. There are three. It's from the three major credit bureaus. If you check your credit, your own personal credit, your score is lower. This is not true. You can check your credit every day. You can go on and monitor it, and even though those scores on most of those sites aren't necessarily relative to what a bank is going to see, it's not an inquiry that's going to harm you in any way. You can look at it every day. Closing old accounts will boost your score. This is probably the single biggest one we run into. I'm closing out my old credit card accounts. When you do that, it can really hurt your credit, because you're taking, like that gentleman that had only that example I gave, he had one card that was closed and it impacted his score that much, from the 8s down to 660. You can imagine if he had 3 of them closed. They're just gone. That whole benefit of having that history and then, the 0 to available, all they're helping us score, now is gone. FICO doesn't see it, so it really can negatively impact you by having those accounts closed. So what we really recommend people to do is keep those cards. If it's Macy's or whatever, just leave it open. You don't necessarily have to use those. They have less impact. But major credit cards, just use them to buy gas and pay them off to where there's a very small balance left. $4 or $5. I don't want you paying extra interest to them, but that helps maximize the utilization ratio of FICO to have a little bit of a balance. They seem to make sense, but I found it to be true. Your age, as well as your income, determines your score. Those are not things that come into the equation at all. Credit card offers hurt you. Again, that's a soft hit to your credit. They don't hurt you. Number 6 is a huge one that we get all the time too. People think when they get married that your credits merge. They do not. Your credit history stays separate, and once you take out joint accounts with everybody, with your wife or husband, etc., those joint accounts are then where you're merged. Otherwise, the past credit history doesn't matter to either party. And then again, canceling it seems to run it, but canceling your credit card helps you score if it's not. This is a good one because, my score determines what I get for a loan. Younger people would be a good example of this. A lot of them have very high credit scores, but there's no history to it. So they look at these other factors, your income, and all those things, as long as underwriting guidelines, etc., are used to evaluate that particular person. So they may get denied for a loan because they don't have a track record. Yeah, your scores are good, but you've only had one credit card for 6 months. There's not enough history there for us to make a lending decision. Reversely, you could have a lower credit score, but have a lot of history, and maybe that event was 2 years ago and you're recovering and you've proven yourself, and they'll say yes to that in most situations. A poor score will haunt me forever. We see this a lot with our clients where there's 2 reasons people don't talk about credit. Something's happened, you're embarrassed, you just think it's totally wrecked, and you may not even know that for sure. Or I paid my bills on time my whole life, and I have great credit. We talked a little bit about those things. You need to evaluate and go through and see how things are, because you may, again, have pulled it online and think you have a great credit score. My score will drop if I apply for new credit. That's kind of getting into what I was talking about with mortgages and cars. You can shop for a period of 30 days where it's not going to adversely affect your credit score. Credit cards is where, and other inquiries is where it can be a little fuzzier. If you applied for 5 or 6 credit cards, FICO is going to get a little nervous about that because it feels like you're trying to acquire debt for some reason. Maybe it's because you're in trouble. Excuse me, my joke's really bad. As business owners, a lot of times we look to pull some money out of our property to finance our business, or look at investment properties, etc. As way, in today's marketplace, real estate is a very good investment. I wanted to bring these up because we run into a lot of situations where people don't realize that even if you're upside down on your mortgage, that the HARP program, which they extended December of 2013, you can refinance your property. At the bottom, the old program was 125%. The program, the phase 2, is going to roll out. It supposedly already had rolled out as far as December 1st. You probably heard on the news about Obama talking about this. Fannie and Freddie were not ready for this. It came to a complete shock. The government just said, you're going to do this. And they said, well, wait a minute. And then you had the problems of banks looking at taking a negative equity asset onto their books. So they had to work this all out. It should come in the next few weeks. It supposedly has an unlimited cap. Market will dictate a cap. We're starting to see some of those. Wells Fargo go to 135%. We're seeing more of the market that's probably going to be 150%. But it's still going to help a lot of people that are underwater to be able to refinance their homes. So whether that's friends, family, or whatever, if you have questions about that, we'd be happy to answer them. Lastly, there's special programs out for small business owners themselves. The biggest thing to parlay to you is that underwriting standards have become much more common sense again. In 08, 07, 08, when you first saw the pendulum of the liar loan, if you will, where someone working at Target as a teller was making 80 grand, that's where it was way too far and over here, and they drawed it out. But it swung way too far this way, where a lot of the people were able to get loans, and we've seen it starting to fall back to where things are common sense. They're not so afraid. Investors are opening up, and just having really good written guidelines and understanding that people have various different things that may have happened or whatever, and we're seeing a lot more people being approved for mortgages that even in the last year that they weren't. Let's get back to some fun facts, I guess. The first credit card was introduced in 1950. It was made of paper or even cardboard. The Anwar is going to issue terms and conditions made you responsible for all charges, even from fraud. In 2012 today, 10,000 credit card transactions happen each second. There's more than 500 million credit cards issued, and that stack of credit cards end up being the power that's 288 miles high. In wrapping this up, I just wanted to say, any type of question you have about credit and whatever, it's good to ask them. The internet is filled with a lot of myth. So you have to be careful from the sources, but stuff from FICO, MSN Money is a very good source with reliable information. Obviously, we at CreditTek have a lot of information. So if you have any questions in regard to that, I hope it was helpful in understanding that everything in your business gets back to you personally, especially in your small business, and they need to evaluate those things and understanding how to maximize your credit profile is real important, as well as on the mortgage side, if you have questions in regards to those types of things, we're free to answer questions. We also have a drawing today if you guys want to enter in we brought in an LCD 19-inch TV high def for you if you want to enter for a drawing for that. But otherwise, I'm Arron Barr CreditTek. Thanks for having me, and thanks for coming.